welcome back to this week's market update. Today is Monday, February 5th, 2024. We had a very full week with a Fed meeting and a jobs report, so we'll jump right in. Looking at last week's market performance, we saw stocks and bonds trade pretty flat to the start of the week and then seeing a large sell-off in stocks on Wednesday following the Fed meeting and Powell essentially saying that they will not cut rates in March as their base case scenario. But by the end of the week, we did see a bit of a rally on Friday with a really strong jobs report, sending the Dow higher by 1.4%, the S&P 500 also higher by 1.4%, the Nasdaq Composite up about 1.1%, and even the Barclays Ag up about 0.4% on the week. Looking at last week's market news, we had a Fed meeting, and that was by far the greatest catalyst in the market last week, in addition to the jobs report. But for most of the meeting, Fed Chair Powell was largely ambiguous, highlighting the strength of the US economy, highlighting the labor market, and then out of nowhere, he explicitly told the press that a rate cut in March was not the Fed's base case scenario, which sparked a sell-off in stocks. So stocks went down. The S&P 500 saw a drop of 1.6%, which was the worst Fed day in almost a year since March of 2023 when the regional banking crisis was unfolding. So it also changed quite a bit in what the market was pricing in for interest rate cuts. We'll take a look at that here. So target rate probabilities for the May 1st meeting. Current as of February 2nd versus 1 month prior here. Here you can see a month ago, the market was pricing in the probability of 2 full rate cuts, a 60% chance of 2 full rate cuts by the May 1st meeting, and now that has kind of flip-flopped. So here you can see the market is pricing in about the same probability, slightly less of just 1 rate cut by the May meeting, and actually a fair chance of 0 rate cuts by the May meeting, rather having a rate cut in June, just with the strength of the labor market, the really low 3.7% unemployment rate we got for January. So it kind of makes sense in the Fed scenario of how they're looking at data. Inflation is still running above 2% on an annualized basis, even though on a 6-month basis, it is closer to that 2% rate there. But we'll continue to take a look at the Fed and how markets are moving and how they're reacting to the Fed. In addition to the Fed meeting last week, the January jobs report was quite big news in that we had an unemployment rate of just 3.7% in January, which was unchanged from the last 2 months, coming in slightly below expectations. But then the bigger surprise came from non-farm payroll. So non-farm payroll rose by 353,000 jobs in the month of January, which was almost twice what economists were expecting. So the industries with the most job gains came from professional and business services, healthcare, retail trade, and social assistance, whereas the job losses were mainly in mining, quarrying, and the oil and gas industry. On the other hand, we saw average hourly earnings grow 0.6% in the month of January from a month prior, which was again twice the anticipated rate. So a lot better jobs report than what was expected in many measures, and that drove markets higher on Friday. Also this week, we got the Consumer Confidence Index from the Conference Board, showed a 6.3% increase in the amount of consumer confidence in January, and that continues this uptrend that we've been seeing in recent months. It also marks a 2-year high in consumer confidence here. So we haven't seen that high of confidence really since 2022, and that is a good sign for consumers. They're feeling good about the economy. They might be spending more. They think that inflation has been coming down. Rates might be, getting cut soon in the near future, and employment conditions are quite stable. So good news on consumer confidence. Consumers are feeling good, and this has been increasing in recent months. Continuing on with our week, last week we had 108 companies in the S&P 500 report Q4 earnings, with companies broadly posting better than expected earnings growth compared to the last few weeks. So that puts the S&P 500, the 200 or so companies that have reported so far, at a 6.8% year-on-year earnings growth rate as a whole. And the largest gains in earnings growth came from consumer discretionary, communication services, as well as cyclicals, and then not far behind were utilities. So good year-on-year earnings growth in those categories. And then we saw things like energy, we saw healthcare struggle quite a bit, and basic materials all down year on year in earnings growth. So really varies by sector as it always does, but as a whole, earnings growth has been looking a little bit better than most had expected. One company in specific that you might have seen a bit of movement last week and you're wondering why is this stock up so much, but Meta last week announced a 50-cent quarterly dividend on Thursday evening during their earnings call. So they had pretty strong Q4 in terms of earnings, but then what really drove this excitement around the stock was that they announced a 50-cent quarterly dividend. So they join the realm of, very top tier tech companies that have enough free cash flow to pay a steady dividend. And granted, this is, less than a 1% dividend, but it is quite significant when you're looking at, Meta 2 years ago had, very limited cash flow. They had super high expenses. They overhired during the pandemic and after the pandemic and have faced quite a few layoffs. Actually, their workforce is down 22% from a year ago, even just comparing Q4 2023 to Q4 2024. The company has slimmed down their costs quite a bit, and that's kind of the reason why they're able to reward shareholders in this way. So that caused the stock to go up quite a bit. This is a year-to-date chart, so it's up over 30% year-to-date, but then, 20% of this gain happened just on Friday following this news of the new dividend, as well as a share buyback plan. So really good news for Meta there, one of the stronger performers in this earnings season, especially with the announcement of the dividend. So thank you very much for tuning into this week's market update, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.